Welcome back to the Australian Fund Monitors Meet the Manager series. Datt Capital is a Melbourne-based, Australian-focused long equity manager. Their fund, the Datt Capital Absolute Return Fund, was started in August 2018 and since then has posted some impressive returns, especially over the 12 months to the end of September 2020, with the fund outperforming the ASX 200 Total Return Index by over 46%. One of the reasons for the strong outperformance has been the fund's excellent up and down market capture rates. As you can see from the table on the screen, the fund has performed exceptionally well in both up and down markets, living up to its absolute return mantra. I'm joined today by Emanuel Datt, the founder and principal of Datt Capital, to talk a little more about the fund. Emanuel, thanks for joining me. The fund has performed exceptionally well coming out of the market low point in March this year. Can you tell us a little bit more about how you've generated such strong outperformance?
Sure, thanks for having us, Damen. So there were a few things that worked in our favour post-March or during that sort of market downturn. There were three main factors. They were sort of the experience, having gone through similar market downturns in the past, taking a rational, practical approach, so sort of looking at the market data and the magnitude of the downturn itself, and being agile in our portfolio approach itself. So I'll probably elaborate on those slightly. So in terms of experience, we'd invested throughout the dark days of the GFC. So we knew what an emotional experience investing in a down market was all about. So, between the 21st of Feb and the 23rd of March, the ASX 200, it fell 36%. And this was, for context, the ASX 200 fell 53% during the GFC from top to bottom. However, this fall was over 18 months. So to fall 36% in a little over 30 days was without precedent in the Australian market itself. And in looking at it in that context, we knew that mean reversion over time was almost an absolute certainty given the magnitude of the fall in such a short time frame. And we recognized opportunity for what it was, which was the perfect environment for a skilled active investor to thrive in. And so then moving on to sort of the rationality perspective or factor, I should say, is so at the time there was a lot of fear around COVID generally, given all the information coming out of China and Italy at the time. So at the time, it was estimated that the mortality rate was somewhere between 2 to 5%, which we thought was quite an overestimation, given that there were difficulties in diagnosing, non-symptomatic and also people who had recovered from COVID itself. So to us, the only real unknown was how the Australian and state governments would respond to this crisis. And once we observed that the federal government was providing stimulus to the economy itself, we felt the catalyst was in place for further market upside and market stability overall. We were very quick to cut non-core positions and buy more exposure to high beta stocks. Close to the bottom. We didn't quite pick the bottom, but we're close enough to do quite well out of it. And the penny really dropped when we realized that many stocks that we'd been watching for years, but had always considered too expensive, were now trading within our valuation ranges, which is quite unusual. So accordingly, we were able to deploy our cash holdings into what we considered quite low risk opportunities in terms of valuation, as well as recycle capital a bit more quickly than we would typically as the market rebounded from its lows. So we're able to ride that market upside and continue to do so quite successfully.
In my introduction, I mentioned the fund's low down capture ratio, and you have an emphasis on capital preservation, which is evidenced by this low down capture ratio. What are some of the things you focus on as a team to manage this?
So since inception, we've managed to capture 140% of the index upside, whilst only 54% of the index downside, which is what you make reference to. So a lot of it really stems from our flexible and dynamic approach towards asset allocation. and taking a multi-asset investment approach itself. So this is, I guess you could probably say this is part of our style of investing itself, given that we're a large investor in the fund itself. So we want to ensure we have a conservative nature in terms of our portfolio construction itself. We sort of invest selectively in fixed income instruments, whilst leaning towards growth equities and special situations for our equity allocations. And we tend to hold a greater allocation of cash than a typical fund. So the overall effect of that is we tend to carry far less equity market exposure and therefore risk than a typical equity fund, whilst trying to achieve similar or greater returns by exposure to asymmetric opportunities in our equity investments. So, consequently, that's led to some high quality outcomes.
There are a lot of differing views on how the next 6 to 12 months play out, and the impending US election will have an influence one way or the other. How are you positioning the portfolio for what is a relatively uncertain future?
I think, David, we're pretty much going to stick to our knitting, keep doing what we're doing. We think that the state of markets over the next 6 to 12 months will depend a lot on government policy going forward. For instance, in March, when governments became active in financial markets just for the sole purpose of stabilizing the market, I mean, to us, it doesn't make sense to stand in front of a train. You tend to, while you do accept that government intervention is generally only a short-term measure, our way of thinking is that you have to really raise your sails and capture as much wind as you can, rather than try and fight against a tailwind, I guess. So I think that there's no secret that governments are sort of bearing a lot more on their balance sheets, so they're effectively debasing their respective currencies. So we're sort of expecting, over the next 12 months or even on a longer term basis, that there's going to be more of a flight or more demand for real assets, and we think gradually over time that commodity prices will escalate, purely as a result of decreased supply, given the COVID situation, and also rises in demand as societies reopen and people want to get out and live their lives after being locked up for so long. So I'm in Victoria, I should mention. So we're feeling it more than anyone in Australia, and so I think that our belief is we can't time markets, but we do know that markets move in anticipation of future events, which is something that we saw demonstrated in real time in the March and the consequent re-rate. So we will always try and invest in sectors where we anticipate a tailwind will be present, via the simple laws of supply and demand. In terms of portfolio allocation going forward, we still intend on maintaining our approach of, achieving a fine balance between growth and defensive assets and staying disciplined. So I think that, in many ways, as we've seen, I mean, the last 12 months has really been an eye-opener for many investors out there. 12 months ago, everyone was all about how great low-cost passive investments were, via the form of ETFs and the like. So, I think in many ways, markets are cyclical, like nature. So you really have to achieve sound return and capture the market upside when it's available. And effectively, that will get you through the hard times. That's always been our philosophy. So we feel that for investors out there, a big risk is not being able to generate a sufficient return during good stable times in the market. And, it's a real opportunity cost, we believe.
As I mentioned in the introduction, you've had particularly strong performance since inception and over the last months. Emanuel, thanks for joining me today and good luck for the future.
No worries. Thanks, Damon. Thank you.
Thanks.